Hi everyone, can everyone hear me? All right, cool. So thank you all for coming out on Wednesday to learn about market making and algo trading for Bitcoin. So I know a lot of you in this room. If you don't know me, my name is Arthur Hayes. I'm the co-founder and CEO of BitMEX, the Bitcoin Mercantile Exchange. And we're a Bitcoin and digital currency financial products exchange. We're most notably known for our 100x leveraged Bitcoin versus US dollar futures contracts and swap contracts. So the purpose of this particular talk is not to talk about really our products in too much detail, but more to talk about algorithmic trading and market making. Because, so my background, I'm a former ETF trader here in Hong Kong. I worked for Deutsche Bank and Citibank as the head trader and market maker for those products on the Hong Kong and Singapore Stock Exchange. And so my job every day was to make continuous markets while the market was open. So taking that into the Bitcoin sphere, same principles, slightly different products, and because it's such a new industry, there's a lot greater profit potential for people who use computers to trade, to do rules-based trading. And so basically this seminar is a very introductory level overview of some technology that we've provided in terms of a sample trading bot and some basic principles of market making. So as an aside, I'm not a programmer. I picked up a little bit of Python just in terms of my day-to-day business, and I can sort of go over and high level the trading bot that I'll present today. Obviously, this is meant to be a starting point, so if you're a more seasoned programmer, this is basically your jump-off point, and you can take this and do whatever you like with it, really. Okay. So if you read the announcement or the invite that I sent through, oh, excuse me, sir, can you step that way? So we have a video camera. Cool, great, thank you. And use of the materials. So if you do have a computer in front of you, it would be great if you can have the slides and or the sample code in front of you, because it'll make more sense. This is a interactive seminar, so please do interrupt me and ask questions. You guys won't get anything out of it if you don't ask any questions. Sitting there like deaf mutes isn't really going to help anyone. And I'm sure that'll inspire other people to ask questions that they may have as well. So here are some links. If you have the slides open, these will lead you to some of the stuff that we'll use today. So the first thing that everyone should do before they start any type of algo trading is get set up in a testing environment. BitMEX is unique as we're one of the only exchanges that offers a staging environment where we use testnet Bitcoin, which has zero value. So essentially you can use this fake Bitcoin as margin on our testnet exchange to try out your trading programs and any new products. So it's a complete copy of the BitMEX production environment, and we put new products and new features on testnet first. So you might notice you see products on here that aren't available on our main site. And to sign up for the testnet, you're going to need a different login account than what you have for production BitMEX. All that is a verified email address. So right into it. Standard API overview. The Bitcoin industry is pretty standard in this respect. Most exchanges offer a REST and a WebSockets API. Some of you in here might be financial services professionals who are used to using Fix. Most exchanges do not support a Fix engine. If they do support it, it's really shitty. So you're going to be using REST and WebSocket. WebSocket should be used whenever you can, because that's going to push live data to your bot. And because the Bitcoin market is very quick and there's lots of other computer programs trading, instead of you pulling the REST API and pulling data down at whatever interval, you want to be pushed in real time any updates on the market. And this is especially a concern because the technical infrastructure of most Bitcoin exchanges is very poor, meaning that you will get rate limited very often. So if you keep pounding an API, most exchanges will take that as someone's trying to DDoS me, so I'm going to ban that IP address for a certain period of time. which means that all of a sudden your bot won't be able to connect to BitMEX or another exchange for usually an hour. So on BitMEX, if you hit our API with either errors or aggressively spamming us, we will ban your IP because we do not want to be DDoSed to the detriment of all of our other users. So when you can, use the WebSocket to receive data. On BitMEX, just about everything we offer is available via a WebSocket connection, and you'll use the REST API primarily for order placement, amendment, and cancellation. So if you do have a browser open, you can try out this call, and this is an example of pulling down data via a REST call. And I'll just do this here on my computer as well. And here you see we get a nice looking array of trading data for our Bitcoin US dollar swap contract. So depending on the exchange, most exchanges will offer you a WebSocket connection to get live updates of trades in the order book. Some exchanges are purely REST-based, so that means you're going to have to continually pull the API for market data, and obviously that is not ideal. Another great feature that we have is an API Explorer. Now this allows you to try out calls before you actually start coding them up. So let's say that I want to know the trade history for the Bitcoin US dollar swap. I want 500 rows, and I want to reverse the trade order. I can try out this call. And here I go. I'm given this in the form of a URL from a curl, and then I can see any response headers here. So this works for both public and private API calls. A public method is anything you can use without actually having an account with BitMEX. A private method means that you need to authenticate yourself somehow. And private methods are for getting your own personal account data, submitting withdrawals, and submitting orders. Next is I'll go through a simple WebSocket example. Now, if you do have a terminal open, you can follow through these steps, but just to show a demonstration. Let's say that we want to, instead of pulling the REST API for trade data, we want to receive constant updates of every trade that comes through on our Bitcoin US dollar swap. We can use our WebSocket in a terminal. Let's see if I can change the
color.
Yeah, the color. Yeah.
If you can get the font bigger as well.
I'm not sure I can get the font bigger. Let's see.
If you're in terminal, just Command plus.
Command plus?
Yeah.
Okay.
Use the basic one at the top.
This is better.
Now instead of pulling it bigger, just try the Command plus.
And so here you can see basically a trade feed for our Bitcoin US dollar swap. And if you look in the sample market making bot, you'll see how to actually do this in Python. And there's other instructions for other libraries that you would like to use as well. So once you've set up your account with Testnet, the next thing to do is to generate your API keys. And this is pretty standard across all Bitcoin exchanges. In order to authenticate your robot to authenticate you to the exchange, you'll be given a public and secret key to use in your program. One note of caution, if you trade on any third-party platforms that ask you to give them your API keys, you're essentially handing over your account to that person. So with these keys, depending on how you permission them, a person can withdraw money from your account. They can place orders on your behalf. So be very careful with how you secure your API keys and how you and what actions you allow to be done using those keys. So if we go on the testnet exchange, API key management, I'll create a new API key, the Hive. CIDR allows you to restrict an IP address. So if you're using a virtual machine or some sort of cloud-based service and you know you're going to have a static IP that's going to connect to BitMEX or another exchange, it is prudent to restrict the access of this key to only that IP address. And here I can choose whether or not I want to allow, what the permissions are, whether I want to allow this to submit orders, cancel orders, and or withdraw money from my account. So we'll just select order, click submit, and now I'm given an ID and a secret key. And you can see a history of all the different keys you've created down at the bottom.
The limits per key, is it per account?
What do you mean by?
Per account.
You can create as many keys as you want. You can limit which IP addresses can access the key.
Rate limits.
Rate limits.
Rate limits are per account.
Per account. Yeah. Now, that being said, we do raise rate limits for people when they ask, but we usually will check your history of requests on our API, and if you're submitting a bunch of bad requests, we won't raise your rate limit until your bot gets correct. All right, so this sample bot that we've put up on GitHub is a Python-based bot. There's a very clear and succinct README file that goes through how to set up this particular bot. And I'm going to go through on a very high level on how you go about setting up this and trading with it. So the most important file here is your settings file. So in here, let's just do this. We have our API URL, and you'll find this on the API overview page. If you're connecting to another exchange's API, they'll have a base URL for submitting requests to the API as well. Again, our API key and secret, this is what we just created via the testnet front end. Symbol, what would you like to quote in the bot? Now this particular bot is basically a very dumb bot. It connects to BitMEX and it will post bid and ask orders around the mid price in the market. I'll go over in more detail in a bit about some more sophisticated ways of market making, but in reality, this bot is only meant to give you a starting point for coding your own proprietary strategies. You can specify how many order pairs you want. One order pair is one bid-ask pair, so if I was quoting market, say, bid of 10, ask of 11, that's one pair. The number of order pairs is the number of levels that I'm quoting on the exchange. I can set how large, in terms of contracts, that I want to quote on the market. And very important here is what is my half spread. So we define interval here as half the distance between the bid and the ask. I'll speak more in depth about the importance of setting a spread and the considerations that go into making that number. But this just shows how wide your quote is. The wider you are, the less aggressive you are, the less trades you're going to get. But the safer you are, because you have more room of error between market movements and how much it's going to cost you to hedge your position. Now here we allow you to set a min and maximum position. This just says if I trade X amount of contracts I will stop quoting that particular side. So if my position went above short 10,000 contracts, my ask side would disappear. For you, those of you who aren't finance background, when I say a bid, I mean my buy price. When I say an ask or offer, I mean my sell price. And in terms of actions, you hit bids and you lift offers and asks. I won't speak in terms of buy and sell, but hitting and lifting trades on the market. Here you'll specify Looper about how often you want this particular bot to run. So every 5 seconds, it will replenish your quotes. Now all these settings are detailed on the README file, and basically this is the BitMEX connector file. So for those of you who are going to use this as a starting point for creating your own program that connects to BitMEX, going through the bitmex.py file gives you a great example of how to connect to our REST and WebSocket's API. Here we have some code about sample calls you can make using this trading bot. Now, obviously, you might want to quote more than one contract. And so basically, what all you'll do is create a new file, settings-xbtUSD, settings-xbth17. These are just the symbols on the BitMEX platform. So they correspond to these symbols here, where you see contract details. So if we change this to our June contract, our contract details, XBTM17. So on BitMEX, everything is referenced by the symbol of the contract. Now you'll have to understand what that symbol means and what the sort of payoff potentials are for that contract, but that isn't really something that I'm going to go over today. You can find all of those details out on the contract details page, or we have a whole page with all the details of our particular contracts. And one thing to note is everything that you see on BitMEX is coming through our API. So you can reproduce all this data straight through our API. There's no need to actually log on to the front end and look at it visually.
Scrape it.
Yes, we scrape it. If you want to lose money quickly, scrape data and quote prices. Now, any, I guess, general questions about the Python trading bot? I don't really want to go into too much detail on it because there's different levels of programming ability in here, and really it's just meant as how do I connect to BitMEX? Here's an example. Take that as you will and build your strategies on. The real nuts and bolts of market making is sort of the theory and what to do in practice that I'll go over in the next section. All right, cool. So why do people market make? Now, as an exchange, our biggest defense against a competitor is the liquidity that is provided on the market. And liquidity is provided by market makers, because the everyday trader only trades when he or she wants to trade. A market maker trades all the time, and they're willing to buy and sell a particular contract 24/7, all day, all night. That's what they're there for. That's the service that they provide to the exchange. Now, how do they get compensated for essentially the liquidity that they provide the exchange? Well, on BitMEX at least, we pay you to be a market maker. So every time you post a passive limit order on the exchange, meaning that if I place an order, it does not get executed immediately, it rests in the book, and some other trader comes aggressively and hits or lifts my quote, we will pay you 2.5 basis points, or 0.025% of the value of that order in Bitcoin, and that's cash, available immediately in your account. The person who is aggressively hitting or lifting your quotes is paying 7.5 basis points for their privilege. So net BitMEX earns 5 basis points on every trade that goes on the exchange. Now, as a market maker, your job is not to take a view on the underlying product. A good market maker doesn't care where the price is going. What they do care about is they want the exchange to have marketed itself sufficiently that there are enough traders who are willing to cross the spread. Because your earnings is determined by how wide your spread is and how many people the exchange can bring to that spread to cross it. And hopefully over time, you make at least half of the bid-ask spread that you're quoting. And if done correctly, you can make consistent income market making. And especially, go ahead.
Oh, just what's the typical spread on say?
Let's take a look. So this is our most liquid contract, our Bitcoin US dollar swap. Today we've traded 45 million US dollars in the past 24 hours has gone through on this product. And as you can see, the bid-ask spread is 1 cent. So fraction of a basis point is how tight this market is. Now that shouldn't dissuade you from market making, because the great thing about Bitcoin is that people are shit scared and high on life. And what that means is they place market orders. And market orders are your best friend. They mean that this person is price insensitive to the size that they input into the market, meaning that you're going to get a good fill on your passive limit order in the trading book, especially during periods of high volatility. And that's one of the best things about Bitcoin, is there's lots of greedy and scared traders. So yeah, even though the market's only 1 cent wide, you'll see people eat through this book aggressively to get the size done, because the market moves so much in such a short period of time.
Plus you still get a 2.5 bits, right?
And you get the 2.5 basis points. So the number one goal of market making is delta neutral. When I speak of delta, I mean your exposure in the underlying of whatever you're trading. So if we're talking about our Bitcoin US dollar products, your delta is in the amount of Bitcoin that you're exposed to the market. So if I'm long 10 delta of Bitcoin or 10 Bitcoin, if the market moves 10%, I stand to gain or lose 1 Bitcoin. So the first concept of market making is fair price. Fair price will differ depending on different traders and how they wish to calculate it, but essentially for a currency futures contract, the fair price is a variant of interest rate parity. So you want to look at the underlying index price. When we talk about an underlying index, we mean what is it that you're actually trading. So for Bitcoin dollar, you are actually trading the Bitcoin US dollar exchange rate, and we'll have an index of different exchanges that compromises how that product will settle. And then it's your cost of capital. So do you consider yourself a US dollar based trader? Do you consider yourself a Bitcoin based trader? It really depends on your outlook on the world. Some traders bought Bitcoin back when it was $1. They're up thousands of %. And so they only think in Bitcoin terms. They're so rich, they don't care what the dollar value of it is. They're up so much. Whereas probably most of you in this room are coming to this industry new, meaning you're a US dollar based investor. You have a bunch of dollars, you're going to buy some Bitcoin, you're going to trade around, and at the end of the day, you're going to sell your Bitcoin, get back some dollars, and hopefully have a net positive return. So those are your two inputs into your fair price. And once you have that fair price, that acts as your mid price. Around that mid price, you'll put your spread and you'll come up with your buy and sell price, or your bid and your ask. Now the reason why I went over that Python bot previously is that these calculations are done continuously via a computer program. Your job as the market maker is to calibrate it correctly to perform how you want it to perform depending on the market conditions. So here's a quick and easy fair price example. I'm using an Ethereum versus Bitcoin contract because the payoff structure is a little bit simpler to understand than some of our more complicated products. So for this product, our Ethereum 7-day futures contract, It expires every Friday at noon UTC, which is 8 p.m. Hong Kong time. And the underlying value is the Ethereum Bitcoin spot price on an exchange called Poloniex. And it's quoted in an amount of Bitcoin. So if we say the spot price is 0.05 and it costs us, our borrow rate of Bitcoin is 1%, our borrow rate of Ether is 2%, using current interest rate parity, voila, we can come up with a fair price. Now, obviously, each one of your cost of funds for each currency is going to be different. And that's influenced by, where you can borrow these currencies from. Now, around that fair price, I will then come up with a desired spread. Let's say that our spread is 2%. And so then I'll subtract 1% on the bid side, add 1% on the ask side, and boom, I have my bid-ask spread. And if the price didn't change, I would just keep quoting this spread all day and wait for people to come and trade against my prices. So once you've determined your mid price, the most important thing and where all of the secret sauce of market making is determining your spread. Now, as I said previously, if you're scared and your spread's wide, no one trades against you, which means you did all this work and you just sit there quoting prices all day. And that sucks because you're not making any money. If you're super risk-taking, your spread is super tight. Imagine if you were quoting a 1 cent spread on Bitcoin. You're probably going to get run over, but you're going to get a lot of trades. You're going to get a lot of 2.5 basis point rebates, but will you make money in the end? I don't know. So essentially, your spread is composed of the volatility of the underlying asset that you're quoting and how much it costs you to hedge, because you're not taking outright positions. If I'm selling a derivative on BitMEX, I'm buying the underlying somewhere else. And at all times, I'm trying to be, delta neutral-ish. You might have a tolerance for risk saying, I'm willing to be 10 Bitcoin long or short Ethereum before I start hedging. And the hedging cost is a combination of the bid-ask spread on the underlying markets, or where the price comes from, and the commissions that you pay to trade. Now, BitMEX has some of the lowest commissions for trading of any Bitcoin exchange, probably because we offer such high leverage. But when you enter the spot market, where you're going to be hedging your underlying exposure, these commissions can get extremely expensive very quickly. You could be spending hundreds of thousands of US dollars a year on commissions on these exchanges if you're a very active market maker. So part of the optimization of your trading bot is the algorithm that you use to hedge your underlying exposure. And that's something that you can spend a long time figuring out the most optimal way to hedge your exposure. But these two components determine your spread. And you should earn half that. So let's just go through a simple trade walkthrough. Yep, go ahead.
Just a quick question related. Do you have futures of different expiry for most products? For most pairs, do they tend to be liquid or?
So the Bitcoin market is quite immature in that usually there's only 1 to 2 more liquid products. Generally speaking, traders don't like, or market makers don't like to make a futures contract longer than 3 months. And mainly that's because the basis, and when I speak of basis, I mean the difference between the futures price and the spot price, which is essentially an interest rate component, is extremely volatile. So it's very correlated to how volatile the underlying spot price is. So Bitcoin's super volatile. As a long speculator with a 100x leverage product, I'm willing to pay an extreme amount of interest to get that long exposure, which means that a future like our June 30th future, which expires end of June this year, say the spot price moves up 10%. The June price, mark to market, might move up 20% because that interest rate component expands quickly. Now, time value says that if a 3-month future is way less riskier than a 1-year future, because that interest rate component can make up a vast proportion of the value of that futures contract. So as a result, The farthest that we've seen liquid is out to 3 months. So for the Bitcoin series, we offer a March, which is expiring in 2 weeks, and then a quarterly June contract. As liquidity increases and there's more and more traders accessing the market, you'll get more and more expiries. The more expiries you have, the more opportunities there are to do different basis trades and play the differences between how a March moves versus a June versus a SEP versus a DEC. So it's, it becomes much more interesting, but we're just not there yet. For the altcoin contracts, like Ethereum, we currently offer one version of a futures contract, which is 7 days in length. We'll be expanding that to a month at the end of this week. All right, so now you have an idea of how you calculate your spread. So it's a simple trade walkthrough. So I'm quoting a market on ETH7D, one contract aside, and I quoted and I posted a bid-ask price there on the screen. 0.05 Bitcoin right. So now I'm quoting this market. A trader comes and lifts my offer. I'm now short one ETH7D contract. I'm being a very conservative trader here. I'm going to immediately hedge my underlying exposure as soon as a trade comes through. So I'm listening to the BitMEX WebSocket. All of a sudden I see that my position is now short one contract. I calculate my delta in terms of amount of Ethereum that I need to buy. I then go and send out an order to Poloniex to buy one Ethereum, and I'm able to buy it at 0.085 Bitcoin. I'm fine to keep my market stable there. I'm now hedged. I'm short one contract on BitMEX. I'm long one Ethereum on Poloniex. And so I keep my market. And now a trader comes the other direction and hits my bid. So now all of a sudden I'm listening again to the BitMEX WebSocket. I've gone from short one contract to flat. But I still am long one Ethereum on Poloniex. So now I need to sell that in the market. And I sell that at 0.065. Right, very simple example. This is all done programmatically. Yes?
Quick question. Suppose the order had been the other way around. Can I short the cash?
So depending on the market, yes and no. So on Poloniex offers margin trading or the ability to short a subset of altcoins. Ethereum is one of those altcoins. Now let's say that you're trading, Augur, which is rep, and there is no borrow market anywhere. So what a trader will do is they'll reach out usually to the developers of the coin and say, hey, I'm going to provide some liquidity on BitMEX. Obviously, you guys want BitMEX to list contracts on your product because it increases the awareness around it, and usually the price goes up because people like to go leverage long. But I can't quote a two-way market unless I have the ability to short the coin. So I'm going to borrow physical from somebody who holds it, and I'm going to pay them something for it. So I've borrowed, so let's say that there was no margin trading on Ethereum. I've borrowed Ether. I've deposited Ether on Poloniex. Now my exposure to Ether is 0. I've borrowed it. I just have to give back the same nominal amount of Ether at the term of the loan, plus some interest. So I go and I effectively sell something I don't have because I've got this supply from another trader, and I can go short.
Does Poloniex has margin for Bitcoins?
So Poloniex doesn't do, I think Poloniex is a Bitcoin US dollar tether market, but it's not very liquid. Poloniex itself is a very liquid market for trading altcoins. So an altcoin versus a Bitcoin pair. Now, if you want to talk about, obviously Bitcoin is the big daddy, and then you're talking, Bitfinex, Bitstamp, OKCoin, GDAX, all these other Bitcoin US dollar, Bitcoin CNY trading platforms. And some of them offer margin trading, some of them don't. And you can also do arbitrage between different futures contracts, but that's a little bit more advanced, and I won't go over that today. And so here's a simple walkthrough of the trade P&L. So as you can see here, I made money on my spread on BitMEX, and I lost money on my hedge on Poloniex, but net, I made money, which is the goal. So my BitMEX spread was so wide that even though I crossed the market on Poloniex, I still made money. Now, obviously, this works for a time when it's a very, Bitcoin isn't that immature that you can do this all day long and make money by quoting a spread larger than the underlying spot market. If we go back to the Bitcoin futures contract example here, so this is about, let's go to liquid swap. The cent wide. This is the tightest spread you'll see in Bitcoin. So if you're going to go into BitMEX quoting a spread wider than the actual underlying spot market, you will not get any trades. So you're going to have to be smarter than this example. And that's where statistics, machine learning, all sorts of other ways of determining what that spread should be come in handy so that you can quote a very tight spread but still make money. And that's why you'll never see a very profitable trader handing out their market making bot for free on GitHub. So not all the time is it that you're going to be essentially flat on BitMEX, i.e. traders are going to go in and out, crossing your spread all day long. A lot of times what happens is that you're going to build up a position on one side because the market in Bitcoin and altcoins is very trending. So, we've gone from, $1,000 at the beginning of the year to a high of $1,300, and these things happen in the span of days. So the market might go up 10% a day for a week, right? And what is everyone doing? They're going long. Who's going short? You, because you're the market maker. You're the dumb money. So, that's why at settlement is something that's very key, because what essentially you're going to be doing is selling something at a higher price, buying it cheaper, holding that position until the particular contract settles. At settlement, your BitMEX position goes away. And so let's say that you were short some Ethereum 7D contracts and long Ethereum on Poloniex, and you did nothing, and the contract expired after Friday. You are now left net long delta, which is not what you want. So you have to be cognizant on how a particular contract settles. And because we have a cash settled futures contract, you're going to receive the difference of where you entered and the settlement price. Now for BitMEX, on this particular contract, we use a 30-minute TWAP, or time-weighted average price. So we take the price at minute timestamps and then a simple average over those 30 time slices. So what would your computer program do? You would say, at 11:30 UTC, which is when settlement calculation period begins, you would pull your quotes. So now I'm left, in this example, short 30 contracts, long 30 Ethereum. I'm going to pull my quotes, and now my bot is going to go onto Poloniex and slice my 30 Ethereum into 1 Ethereum slices and submit those on the minute into the market. Now, the effectiveness of this TWAP algorithm that I've built, if I'm good at it, then I will hit exactly the settlement price of BitMEX, and I will be no worse off because I sold my Ethereum at the price that my futures contract expires. Now, obviously, most of the time you will not be expiring your futures contracts. You will try to roll it into the next expiry. But, however, Bitcoin and the altcoin markets are still quite immature, so we don't have calendar spreads or roll contracts, which some of you might be familiar with in, say, if you trade HSI or HSCI futures contracts. You most certainly will not be trading the 5-minute TWAP over the Hong Kong closing session on the last day. You'll probably roll your contracts. And this is probably one of the most important things about market making on BitMEX especially. So we have a concept of post only, or participate, do not initiate. And basically, this ensures that you always are a maker and that you'll never submit an aggressive limit order that would cause you to pay fees to BitMEX. So every trade you do, you get paid. And when you send down your request via the API, you'll put in an exec instruction flag of participate, do not initiate, and that will ensure that you'll never submit an aggressive order.
How does that work? Because they just check if you'd hit somebody and then reject it.
Exactly. And you'll receive a reject message saying that this would cause you to be a taker, so we have not submitted that order. So once we've gotten the basic understanding of how we're going to calculate a fair value, settle our contracts, a simple trade walkthrough, the next most important concept is the concept of skew. So as a market maker, you are always wrong. The market is always right. So if you're going short, the answer is not to sell more at the same price, it's to raise your price and sell at a higher price. Similarly, as someone's hitting you on the bid side, it's not, oh, I'm hot shit, I know the market's going up, it's I better lower my price. Because especially in the Bitcoin market, those with inside information will trade against you well before the market gaps lower when the information is made public. And you'll see this happen all the time. So it is essential that you have a skewing mechanism whereby you adjust the price of your quote relative to your net position on BitMEX.
Can I see who submitted the other order?
No. Yes, you're trading. I don't think you could. In most markets, you won't know who you might know who the broker is in Hong Kong. I think.
Yeah, you see the brokers.
You can see the brokers in Hong Kong, but yeah.
26 has traded.
Yeah. Yeah, that would be nice to know if Roger Ver is trading against you. You probably know you're fucking wrong. So, obviously, one other concept of skew is hedging. So, the more hedging you do, the less money you make, because hedging incurs trading fees. So, basically, your goal is to use skew to make your trade attractive to the other side, to flatten out your position before you need to go into the underlying market and hedge your delta. Now, for the simple rule, for each full-size transacted, you skew your quotes half the spread. And I'll go over that in this example. Now, let's say that we're quoting, again, Ethereum 7D, 1,000 contracts aside, and there's my market. I'm lifted for 1,000 contracts, meaning I'm going short. And my spread here, 0.05 is my spread. And so I'm going to move my quotes half of that higher. Because the goal is, okay, so I've moved my quotes higher, maybe my bid price is more attractive. There's someone who wants to sell. I can get a quick, someone hit my bid and boom, I've made half my spread. Great, happy days. So I've moved my market higher, and then good news, someone comes in, hits my bid, and now I move my quotes back down to where I started. And here is just a simple walkthrough on the P&L that I make on that trade. So not only have I made half my spread, I've also made my rebate on both sides of the order. Now, if I had to go into the underlying market, or if I was very risk averse, and I said every trade I do, I'm going to send a hedging order immediately to the market, then I would have missed out on a profit opportunity. Now, obviously, the best optimal conditions for when you basically don't do any hedging is a low volatility market with very active two-way flow, meaning that there's buyers, there's sellers, no one really has a clear idea which direction the market's going. Essentially, you love choppy markets because traders don't know which way the market's going, and they're just going in and out of positions, buying and selling, and you're just earning fees and not hedging. Happy days. Bad conditions. High volatility, trending market with one-way flow. So this is like when, I don't know if any of you were trading during the recent SEC ETF announcement. So ETF announcement came out, I think it was like 5 a.m. Hong Kong time a few Fridays ago. And all of a sudden the market gapped down 20% in under 3 minutes. So that is when you as a market maker will get your ass handed to you, most likely. Now, obviously, you're going to have days where you do have drawdowns because there is a very one-off event, and if you were ballsy enough to quote during that market, you could get run over. But the hope is that over time, when things mean revert and the things calm down and traders don't really know which way the market's going, you make back that loss and more in choppy markets. Now, the key to this particular strategy is how much delta or how much risk tolerance do you have as a trader? And that really is a personal or firm decision on how much risk you're willing to take. And as I said, more risk, less hedging, more profit, potentially. Now that is, so that particular skew example is a very simple, I guess, model for purely position-based trading. When I mean position-based trading, I mean that all I care about is I started at flat, i.e. zero position on BitMEX, and I went long or short in terms of the amount of contracts I held, and I skewed my quotes up and down depending on my net position on BitMEX. I don't really have a concept of basis or fair value. I don't really care. I just want to move my quotes up high enough so that I get the other side to earn my half the spread. So if you have a very small balance sheet, that's a very effective way to market make. But if you have a larger balance sheet and you're willing to commit more capital to doing market making, it behooves you to be a basis market maker. Now when I say a basis market maker, meaning that I want to capture opportunities where my portfolio is positive theta and or positive carry, meaning that I'm going to sell a futures contract more expensive than where I buy the underlying spot when taking into account my cost of capital. So let's assume that the Ethereum 7-day contract is trading at a 10% outright premium and there's 7 days left until expiry. This is a very common occurrence in the altcoin space where the things are very trend driven. So Ethereum, I think in the last 10 days is up something like 300%, right? So you see either a massive basis, meaning that traders think that the market's going to crash and they're constantly shorting it on BitMEX, or they think that the thing's going up parity with Bitcoin in a week. So they're going long and strong, and they're willing to pay aggressive interest rates for 1 week to put on that position. So let's assume that I can borrow Bitcoin for 1% a week, and I can put a basis trade on, meaning sell future, buy spot at 10%. So I net earn 9% on my portfolio by putting that trade on. Now, I'm going to start quoting, assuming I have a flat book, meaning I'm only going to quote the offer side. Because in this particular market making strategy, I never want to be in a position where my portfolio is net negative theta. I always want to have a positive carry, meaning I'm earning money every day from just sitting there. So I'll go net short Ethereum 7D on BitMEX. I'll buy some Ethereum on, say, Poloniex. Once I have a net short position on BitMEX, I'm fine to quote a bid on the other side because I'll just make the spread, and I'll quote that all day long. And as the week progresses, I'm quoting my bid ask, and slowly, the market's decaying. So on my core position, I'm making positive carry as the week goes down, and I'm also making bid-ask spread by market making on the platform. And as soon as my BitMEX position is flat, I drop my bids out, and I'm offered only. Similar thing if the contract is trading at a discount. I'm only quoting bids, meaning I'm buying on BitMEX, shorting on the underlying exchange, positive theta, positive carry position. As the market trends and decays upwards, I'm making spread. If for whatever reason I go flat, then I drop out my offers and I become bid only. Now this is very, very simplistic. Some traders, if they have massive balance sheets, so if some of you do this at an investment bank, your balance sheet is essentially limitless. You say my cost of capital is 10 basis points, HSI versus cash is 30 basis points, take out stamp, and then minus 10. I'm making that spread. I will sell this spread in any size all day long, all month long. And that's what they do. It is not skillful. It is balance sheet and technology. That is all it is. And that is your edge in Bitcoin, because if you approach it from that particular mindset, the people you're trading against are not about balance sheet. They're all about this thing's going to the moon, this thing's going to zero. And that gives you amazing opportunities to put on positive theta portfolios and still earn a bid-ask spread throughout the life of the contract. So in more of a generalized model, I'm looking at what is my cost of capital and my home and my foreign currency, the spot price of the underlying. Is that a positive fee to trade? Do I go one direction and then quote the other side as my portfolio has positive carry? And so that is basically all I have for today. Now you can see here on BitMEX, market makers tend to quote very static sizes. So this guy here is a large firm, and they usually quote 25,000 contracts. And you can see them here at this price and quoting down here at this price. So once you get your trading bot up and running, you'll be able to very easily tell who's a market maker, and the way in which they skew your quotes. You'll be able to start looking at an order book, and I can tell how a market maker has coded their bot just by the way that the quotes move. Some people like to be front runners, i.e., okay, if you're posting at 10:01, I'm posting at 10:02 because I really want that 2.5 basis point rebate, and that's how we get markets that are a few cents wide, because people are trying to beat you on speed. Some people can beat the market on balance sheet. Some people can beat the market on their ability to price jump risk, i.e., how is a volatility going to change from one point to another point in the future. If I can anticipate that change, then I can quote tighter in the market. And so you kind of get a sense for what different people are doing. And obviously, once you have the basics of this, you can take this to umpteenth levels of complexity in terms of how you calculate your quotes, how you move your quotes, how you hedge your underlying exposure. That's obviously one of the biggest determinations of how much money you're going to make as a market maker. How good are your execution algos on Bitfinex, on OKCoin, on Poloniex? Because a lot of the money that you are paying away is in terms of spread and commissions on those exchanges. So taking advantage of their maker-taker fee structures, taking advantage of how one exchange leads, one exchange follows to determine how you're going to quote your prices. When is the market going to reverse? Maybe I shouldn't hedge at this point. I'll wait a few seconds to get an order in to get a better price. You can start going to serious levels of complexity, but at the end of the day, the goal is quote a spread and earn a portion of that spread market making consistently over time with very low volatility of your profit. So any questions? I'm sure there's questions. Be happy to answer them.
Can you tell us a bit more about the index on the Bitcoin swap?
Sure. So right now, the Bitcoin swap takes an equally weighted index of the Bitcoin US dollar price on Bitstamp and OKCoin International, which is their .com site, which is accessible to non-mainland Chinese. In about a week and a half, we'll be moving to an index that's equally weighted of 4 exchanges. So we'll be adding GDAX and Bitfinex. And so for this particular product, without going into too much detail, we use this index price as an anchor, and we calculate an interest rate that buyers and sellers will pay each other every 8 hours based on where the swap trades, the actual last price trades versus the underlying index, because there's actually no expiry date for this particular product.
And you use those 4 exchange API to get fresh.
Right. So our trading engine will take data from those APIs and then mark people's positions. That's somewhat every 5 seconds or 1 second, Ben?
5 seconds.
5 seconds, yeah.
And is the build index available through your API, like the underlying price, the index price?
We'll be making that available shortly, but it's pretty simple. So if you have your already API connectors, you put in the weights and you'll change it. We will be rolling out basically a real-time feed, so you can subscribe to a Websocket feed. It'll tell you, okay, Bitstamp 50%, OKCoin 50%, because we'll be rolling out some more sophisticated basket-based products in the future, where In order to properly market make it, you need to know what the composition of the basket is, and it'll change over time.
But at the moment, on the instrument table, we push out at all times, in real time, the underlying index price, the calculated fair price, the mark price, the last price. So we publish the index, but we don't publish the constituents.
That was my question. And regarding the backlog of product, you said you have some product in the making.
Yeah, so one thing that we're thinking of doing is altcoins are becoming more and more popular, but there's so many altcoins. Mostly what you want to do is I want to get an exposure to, say, the top 5 altcoins. I don't want to have an Ethereum wallet, a Monero wallet, a Dash wallet, because I'm probably going to lose my keys. Maybe the exchange gets hacked. Maybe the tech that the actual developers put that coin on in terms of the wallet they offer out is not very good. So I just want to hold a Bitcoin denominated product that gives me the exposure to a basket of altcoins. So what we'll do is we'll construct an index, say, of the top 5 altcoins by market cap. We'll weight them accordingly, and you can trade a derivative with leverage on that particular index, and it'll settle on the index price. So similar to if you're trading, lots of investment banks will offer certificates, say, of the iPhone manufacturers in Taiwan. You can buy this one basket, and we'll give you exposure to these 10 stocks, kind of thing.
Is the Q parity first in, first out for the same level of the book?
Yeah, it's price then time priority.
Is there any demand for Bitcoin options these days against dollars?
So the problem with options is that the Bitcoin ecosystem is still very immature. So a lot of the traders on here do not have a financial background. They probably haven't traded retail options in the US. I'd say the US is probably the most sophisticated retail market for options, or plain vanilla puts and calls. I'm not talking about the super risky warrants that people trade here in Hong Kong. That's just gambling and HSBC taking your money. For actual understanding of what they're trading, it's not there yet. People are just getting used to trading leveraged futures contracts, just understanding the concept of why does a futures contract trade at a different price than the underlying spot price? What is this basis component? What is this interest component? So once the market understands derivatives a bit more, it'll be easier to offer an options product. And the other problem with options products is, in terms of getting the right user experience, is very difficult to get a proper trading platform, because it's not like I can go to Scottrade and say, hey, Scottrade, connect to BitMEX so I can trade options. Not going to happen. We built this front end, we maintain this front end, and other exchanges do the same thing. So once we feel comfortable delivering a proper experience to trade options in the right way, then it'll take off. Now, there are platforms that do offer plain vanilla puts and calls, but for those reasons I just mentioned, the volume is very anemic.
What's the incentive? It looks like there's already a good quality of market makers on it. Why you want to have doing more?
I mean, so we trade on average about $60 million a day across the whole platform and every total of the products. Now, what does Apple trade a day? Like a few $100 billion of flow? Like, Bitcoin is irrelevant. We're not even close to having enough liquidity to attract larger traders. So if you go, if you have a hedge fund and you have assets under management, $100 million and above, you can't touch Bitcoin. Regardless of whether or not you believe it's a scam or not, you just can't move the needle. You can't go into Bitcoin with a $2 million position without moving the market, 10, 20%. Right? So we need more liquidity. We need more people who have financial services background. We think, oh, this is a great opportunity for me to make some money. Let me add some liquidity, because that it builds on itself. And instead of trading $60 million a day, we're doing $1 billion a day and $10 billion a day. And suddenly Bitcoin as an ecosystem becomes a real player in terms of FX trading. With the dollar does something like $5 trillion a day in volume, and we do 60 million, we have a ways to go. And that only is going to happen if more people understand the opportunity that's here to make money market making.
I will check for myself, but what's the pattern like, the seasonality during the day and during the week?
I haven't really analyzed that, but I'd say that usually it kind of follows FX markets. So you get sort of the China morning, Europe coming in, US coming in, sort of pockets of trading activity. But then again, you have random news events, or exchange gets hacked or something. So there's always something going on. Or somebody sent a tweet out and people are freaking out, or think that Bitcoin is going to the moon. So it's who knows.
And you've been more than 23 hours a day, right?
24/7. There is no BitMEX is not down. You can trade all day. I hope you trade all day.
In the year 2016, we had a total of 1 minute downtime for the whole site.
Congrats.
That's why we need algo trading, because if you try to market it by hand, you can do it for 48 hours, and then you will just go insane. You need a box. You can't trade.
That sounds like you've got painful experience.
Yeah.
I can tell you all the things not to do with forex trading. But you need a bot.
All right. Well, thank you everyone for coming out. If you have any other questions you want to speak to me afterwards, just come up here and we can chat. But I hope that you'll take the materials that we've presented today, and you've seen an opportunity to make some money, and you'll take your knowledge and apply it. So thank you all for coming out.
It was filmed. It will be put.
Yes. So this film will be put online in probably a week or so, and we'll also have it translated into Chinese as well, subtitles. So yeah. Thanks for everyone.
Yeah, grab some beers.